Hey everyone, welcome back to Upside Down Data. Today I want to talk about Hedera-Hashgraph and how we can navigate the market like smart money and not like dumb money. So when you're looking at an asset like HBAR, really any crypto asset, there's a lot of information that gets thrown out there, a lot of noise that you have to sift through. And what is important? What should we pay attention to? How should we think about when are actual good accumulation points and when are actually good distribution points? Well, the first thing I want to say about smart money is that smart money does not think about things in black and white terms. You will not see smart money investors saying that anything is guaranteed, anything is 100%. That's just not the way that investing works. Investing is inherently probabilistic. There are probabilities of continued upside and downside, and the idea is getting the money in when the probabilities are really weighted in your favor. So for example, when the probability of upside really outweighs the probability of downside, and the reverse. Once you get to a point where the probability of downside is way larger than the probability of upside, you probably want to be exiting that position. So let's look at some examples. So I want to show first an example of what I might consider to be not smart money or a not very smart money way of approaching the market. So this is an example, and not to take any particular shot here at HBAR to the moon. I'm just using this as an example. This was back at September 29th, 2021, right around when HBAR put in its all-time high. And we saw was a lot of tweets like this. So again, I'm not singling out just this one Twitter commenter, but you saw this everywhere with HBAR. There people were saying, after it had cleared above 50 cents, people were saying, $1 is inevitable, here $10 is inevitable. We're just gonna go off to the moon. It's gonna be up only from here on out. But of course, if we go look and see what actually happened from that point, so this is from September 29th here, all the way down to where we're currently trading today, HBAR is down 78% from that point, and its max drawdown was all the way to 88%. And so even if you agree with that commenter that, even if you think that eventually we'll see a $10 HBAR, I'm not going to make any comments about that, it's still the case, though, that you probably wouldn't have wanted to be dumping all your money in when HBAR was trading up here at 30 cents. You probably would have been waiting until it was back down to 3 cents before getting in and moving back up. And that's, again, what distinguishes smart money from what's often called dumb money, where in these market cycles, in these phases, in these bull markets, the smart money is selling through this time as you hit the all-time high, and the kind of quote-unquote dumb money is buying. And that's just what happens. There's a lot of emotion that happens in bull markets, and a lot of people just think, well, prices have been going up, they have to keep on going up forever, and they don't know when to stop. Greed takes over, and they end up being left held with the bags. Meanwhile, the smart money's already sold everything. They're waiting for these nice, tasty, low prices before reaccumulating to then ride whatever the next move up might be. So, as I mentioned then, it's this question of probabilities. How do we know when the probabilities are stacked for us versus against us so that we can play that same game that the smart money is playing? Getting the money in when the probabilities are favorable and getting the money out when the probabilities are unfavorable for continued upside. And so to that end, what I want to talk about here is a model that I've been working on. If you've been following the channel, you've probably seen me talking about this already. This is the probabilistic forecast model that I've been developing. And what I really think is useful about this and where it fits in with what we've been talking about with kind of this idea of quote unquote smart versus dumb money, that this model is designed to give you that exact information I was just talking about. Probability of upside, in this case, 6 months in the future. And this is the kind of way that smart money will be approaching the market. They'll be thinking, what are the probabilities for continued upside or the probability for likely downside? So what this is showing you, the blue line here is the output of the model. The green line here is HBAR's price across time. And the y-axis here is the probability of upside 6 months in the future. So basically, this is, if you just multiply these by 100, you get to percentages. So you could think of this as being 100%, 90%, 80%, 70%, etc., going all the way down. And so 50% would be that it's like even split, that it's equally likely there'll be upside versus downside in the next 6 months or 6 months from now. Whereas if you go above 0.5, so for example 0.7, that would be saying there's a 70% chance of upside 6 months in the future relative to whatever price is right now. And then likewise, as you get down to these levels, like 0.1, 0.2, 0.1 would be saying only a 10% chance of upside 6 months from now. And so if you look at this model, what it's telling you is look right around when we're getting to the all-time high, right in this region, right when, you know, people on Twitter were saying, oh, we're going to go off to $10, a dollar, $100. You know, people said all sorts of crazy things during this time in late 2021. Look at what the model was saying at that time. It was giving, at best, 40% chance of upside 6 months in the future, and really more like 20% down to 10% as we got through to this peak here before going on this epic bear market. You know, this horrible slide in price. I think anyone who was in HBAR this whole time, the pain was all too real. Everyone kind of felt that quite acutely all throughout 2022. But then importantly, note what happened as we got down to the lows of the bear markets, or at least what's so far been the local low down through here. Well, the model's getting bullish again. It's now moving up, and then as the time we actually went and hit the bottom, it got the most bullish. You know, it was saying there's an 80% chance of upside 6 months in the future right here. And in fact, now it's gotten even a bit more bullish, up at around 86% probably of upside in the next 6 months or so. And look what happened to price. We ended up hitting that local bottom, and now we've rebounded. We're setting in potentially a new higher low here, and maybe setting the stage for beyond the rally more to the upside, assuming the market allows. And this, again, is how the smart money will think about it. They will be assessing what are the relative probabilities, and they'll be investing accordingly. And what's useful about a model like this is it takes a lot of that hard work out of the equation. You know, if you're just going about the market on your own, if you don't have any data to be looking at, it's really hard to come up with these probabilities on your own. How am I supposed to know what's important if you're just kind of the average investor who's just kind of looking at things on your own with no data, with no models to help you sort out what's useful and what's just noise? You could very well have been a person who at this time felt like objectively the probabilities were really in your favor to be investing, that you thought HBAR was just going to go off to $10. Certainly everyone was telling you that that was going to happen. And so I think people can be forgiven for having kind of FOMO'd in at this point, because in that time when emotions are high, there's a lot of confirmation bias. People just want to believe things are going to go up, up, up. Subjectively, the probabilities might feel like they're in your favor, but objectively, they very much were not. Objectively, they were extremely against you at this point in the market, and that's exactly what ended up happening. And so that's where this model is really helpful, is it gives us a tool to assess these probabilities that don't just rely on our subjective evaluation, our subjective point of view, which tends to be very biased by things like emotion, by things like what other people are telling us. And we all know with those crypto influencers or people on crypto Twitter, they are not right very often, and especially not at the height of a bull market. They're going for engagement. They know that bull posting is going to get a lot of people happy and excited, so they just do it without worrying about whether or not it's actually accurate. That's not the way that we operate here at Upside Down Data. We are data driven. And so if the data are telling us that it's time to be bearish, we're going to be bearish and not worry about what people might want to hear, what they might want to be true. The market doesn't care what you want to be true. The market is going to do what it does. And so the best that we can do is identify which way the market's going and react accordingly. Everyone wants to sell the top, but when you're at the top, almost no one sells because you get greedy and you think prices are just going to continue to the upside and you fear missing out. But that's where having these data can really help cut through that noise and give more useful information. So obviously none of this is financial advice. You should make of this model and these data as you will, and of course everything else that I've been saying. But that's one of the things that I think is just important to understand with crypto markets, is that you'll hear those terms thrown around a lot, this idea of dumb and smart money. But really what it's getting at is kind of more sophisticated approaches to navigating the market versus more kind of unsophisticated or just emotionally driven ways of approaching the market. And generally speaking, the latter, that more emotionally driven version, is not going to be successful in the long term. It'll lead you to buy at the worst times and sell at the worst times instead of selling at the best times and buying at the best times, like what the kind of quote-unquote smart money will do. So this model is not currently yet available at our website, claritydigital.io, but we will be launching it there soon, so stay tuned for updates about that. And I will be tweeting more updates and things like that related to this model going forward. So go ahead and follow us on Twitter to see more updates about that. But I really just wanted to kind of give that point across, this idea of thinking probabilistically about markets, and that this, I think, is a fantastic tool to be able to do this. And this is really the only tool that is available to do this. I have not seen anyone else have a model that tells you anything like this. I think this could be a game changer when it comes to navigating crypto markets. Having a model that could actually give us those probabilities, which are really the key, in my opinion, to navigating the market successfully. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. A lot of updates for indicators and more over there. And check out our website, claritydigital.io, to see real-time data from the rest of our models.